Welcome back, RFC1011. This is the start of lecture 2. If you remember in lecture 1, this is the textbook here that you are required to get hold of or purchase. Applied Accounting, Revised Edition 2019. Let's get going with lecture 2. In the last lecture we looked briefly at ethics, and we've already looked at some accounting terms. You've had a look at more chapter 2 than chapter 1. Chapter 1 in this textbook is on ethics, and like I said in the first video, lecture 1, we've dealt with what you need to know about ethics for now. In this particular module, we're really getting into things more in chapter 2. So I take it you've been reading through chapter 2 if you have the textbook and you've watched video 1. Like I said, we'll discuss the module guide when we get together, what's required to get through RFC 1011. It's raining outside and there's now a little bit of thunder, so if you do hear that in the background, I apologize. So we looked at ethics, and there were just one or two things that I wanted to point out, and then also just a little bit about your behavior. In lectures we need you to be silent and focused. Like I said, there will be time for questions, but distractions break concentration and you make this subject harder than what it actually is, as you're not paying attention in class. So be considerate to those around you and of course to yourself. Pay careful attention in class. If you're late for class, please enter the classroom at the back and sit at the back so you don't disturb the lecturer or any of your fellow students. All the lecturers, we're here to serve you and we want you to do well. So we're in this together. Let's get through it together. I play my part, the lecturers play their part, and you play your part. You take responsibility of getting through the exam. Right, ethics in your life. I'm quickly just going to go through to the second point. You have a good work ethic. We've discussed it. You're going to be working consistently. You're going to stay motivated even when the going gets tough, and you're going to manage time well. You're not going to leave accounting till the last minute, and you're going to put in a wholehearted effort, and you're going to complete the tasks or exercises that you're given, because they will be fantastic preparation towards tests and exams. So you're a well-motivated student, and you can read through a good workplace ethic. I've gone through that. And then just good accounting ethics. Accountants are supposed to be honest. They record things accurately. They're transparent in how they disclose information, so it's all trustworthy, and the stakeholders can reach decisions responsibly because you, the bookkeeper, are going to record your books accurately and honestly, and you're also going to know how accounting works because you're doing RFC 1011. Right, what is accounting? We've looked at that. We're going to use the double entry system. We're going to record all transactions, and we're going to record all those transactions in journals, and we're going to present the information in financial statements, which are going to be used by managers, owners, investors, banks, etc., all the stakeholders. And those stakeholders will be able to make, based on your accurate records, informed economic decisions about whether the business is profitable, financially stable, or worth investing in. Do you know, if you want to get money, to invest into your business and you're trying to secure a loan, you're going to have to present the financial statements and details about the business to your potential investors. So a little bit about what is accounting. Right, liabilities. Let's move on to new terminology. You get non-current liabilities and you get current liabilities. I might have discussed current before, but what current means is the 12 months that we are reporting on at the moment. So it could be from the 1st of January to the 31st of December, but the current financial year or period is 12 consecutive months. Now, if a liability is actually a long-term liability, it's called a non-current, which implies that the liability needs to be paid back over a long period of time. If it was a current liability, for example, a creditor from whom we bought on credit, another word for creditor, supplier, from who we've bought from in credit, those are current liabilities. A non-current liability is a long-term liability. So a liability comes about when we borrow money or we buy something on credit. Buy now, pay later. The above two types of transactions result in the business owing money to either a financial institution or a supplier. We are liable to pay back the loan, and in the case of a supplier, settle our account with the creditor. Another word for supplier. A bank would be an example of an institution where we would secure a long-term loan, a non-current liability, for example, a mortgage bond. And an example of a current liability would be a supplier, creditor, like the computer store from which Calibu Education made purchases on credit. So there's a non-current liability, long-term obligation, money that's paid back over a period of longer or greater than 12 months. A short-term obligation, you're paying back money, you're paying a liability that is in the current period within the 12 months we are reporting on. For example, a supplier. So a current liability and a non-current liability. Important. And just a bit more about liability. For example, here, Calibu Education buys from the computer store on credit. Calibu bought tablets and accounting software from the computer store, and Calibu owes the computer store money. So Calibu is liable to pay the computer store. A liability is a present obligation that a business owes to another party, which must be settled in the future through payment. They say you can pay in goods or services, but we deal with paying cash to settle our debts with suppliers. So there was a transfer of an economic resource relevant to the business. What that means is Calibu bought tablets to sell to students from the computer store. The tablets are relevant to Calibu Education because it's the type of stock that Calibu Education would sell. So we've looked at current liabilities, non-current liabilities, and what is a liability. And at the same time, you're reading through the textbook, so you might already know this, or you did accounting at school. Right, a non-current liability, I'm not going to speak here for too long, is a non-current item. For example, a long-term loan from the bank which is going to be paid back over 20 years. Non-current, a long-term liability. Right, what is debit? In accounting, you get debits and credits. A debit entry is an entry that is made on the left-hand side of an account. Here we have the bank account in the general ledger. All accounts are divided into two sides, a debit side and a credit side. On the left-hand side, the debit side, will be columns for date, details, folio, amount. On the right-hand side, there will also be date, details, folio, account. Now, during your accounting student career, you might hear about T accounts, and this T here is derived from the general ledger because there's a left-hand side and a right-hand side. Often, lecturers will use T accounts to explain transaction entries into the accounts, or you can use T accounts for working. But for this slide here, you need to know the debit side is the left-hand side in the general ledger. There we go. That is the debit side. Now, on the other hand, we have the credit side. The credit side is the right side of an account. We divide this account here into two. The left-hand side was debit and the right-hand side is the credit. I explained to my other class, so I'll do it for you. The abbreviation for debit is DR. You would think it would be DT, but I'm telling you why it's DR. A bit of trivia. DR comes from the Latin word debitera. So it ended up with an abbreviation DR. And CR comes from the Latin word creditera. So it is CR, not CT for credit, because this accounting was created in the 1400s, by the way, by Luca Pacioli, who was dubbed the father of accounting. He recorded this principle of double entry. So that's where this dates back to, a long time ago. So the right-hand side of a capital account is the credit side. The right-hand side of a general ledger is the credit side. And the left-hand side is the debit side. And that's spinning, right-hand side. Now the principle of double entry means that the debits will always equal the total credits. This accounting is magic. Like I say, Luca Pacioli used to hang around with Leonardo da Vinci, very intelligent people, and he wrote a book, The Father of Accounting, where he documented this principle of double entry in 1494. You can go and Google it or Copilot. The father of accounting, Luca Pacioli. He was a monk from Italy, a friar, a monk. There's some information for you. Now the principle of double entry I'm going to demonstrate with the transaction. The owner, Richard, made a cash contribution to his business of 20,000 Rand. When the owner makes a contribution, it will get recorded in the capital account. And according to a rule, which we will discuss in the future, an increase in capital, the rule says it must be credited. So the 20,000 Rand is entered on the credit side of the capital account. Then the bookkeeper takes this money and deposits it in the business bank account. The bank account, if it has a positive balance, is an asset. And a rule says the increase in the value of an asset the account will be debited. And guess what? According to the rules, the debits equal the credits. Very clever, this system of accounting. Your debits will always equal your credits. The value of the debits always equals the value of the credits. After every single transaction, at least 2 accounts will be affected. Sometimes they're 3. It doesn't have to be an even number. As long as the value of the transaction, the debits equal the credits. So there's the principle of double entry. What is a debtor? Now in business, your business will make sales on credit. You will allow people to open accounts with you to increase your sales. Obviously, you're going to check up on these people you're opening accounts for. Look at this example. Calibre Education sells products to the school on credit. So the school is now a debtor of Calibre Education. And by the way, a debtor in the books of Calibre Education is an asset. A debtor can also be known as, or debtors will be summarized in a general ledger account called accounts receivable. So a debtor is a person or business that owes money to our company for goods or services received on credit. So Calibre sold to the school on credit. In the books of Calibre Education, the school is a debtor. That's what a debtor is. Right, what is an entity? An entity is an independent unit such as a person, business, or organization whose financial activities are recorded separately for accounting purposes. An entity is a business. So Calibre records all the business transaction in Zoho Accounting, which is free software up to $100,000 in sales. If your business is making more than $100,000, you will start to pay for the software, which is quite interesting because you can have your own free software if you start up your own business. Zoho Accounting is an example of that. So an entity, a business, or any independent unit that records their information in an accounting, let's say, software package. Manual bookkeeping is not done much anymore, but the reason you're doing this course is to understand what's happening in the software. You need to understand what the software is doing. You can learn any software. All the software is based on accounting concepts and principles which are put in place by the International Financial Reporting Standards, generally accepted accounting practice. A little bit of extra info, but you need to know what an entity is. Right, equity. It could just as well say owner's equity. Equity is what is left over, the residual interest in the business after all the assets have been used to settle all the liabilities, representing the owner's claim on the business. For example, if you took the value of all the assets less the value of all the liabilities, and what's left over will be the owner's equity, the owner's worth, the owner's interest in the business, what the business owes the owner, however you want to see it, but owner's equity is equal to the value of the assets less the value of the liabilities. So what is owned less what is owed. In this example here, I will just say the business office is an asset plus the business vehicle is an asset less the long-term loan with the bank is equal to owner's equity. All assets less all liabilities is equal to owner's equity. Another way of calculating owner's equity is by taking these four elements, what the owner puts in, capital, less what the owner withdraws from the business, plus income earned by the business, less expenses incurred by the business. So owner's equity can be calculated in two ways. 1, 2. The value of the assets minus liabilities, and you'll get the same value for owner's equity if you use either one of these methods. And I threw in the dice there because C, I, D, E forms a word, dice. So if you want to know what affects owner's equity, dice, drawings, income, capital, expenses, capital plus income minus drawings minus expenses. But if you want to remember the four components of owner's equity, think of a dice. Owner's equity is equal to assets minus liabilities. The left-hand side is equal to the right-hand side. In an accounting equation, if a transaction takes place, what you do to the left-hand side somehow will end up you do it on the right-hand side. Unless, of course, it's a plus and a minus under A. But more about that in time, all in good time. Income. How does a business earn income? Income is the money a business earns from its main business activities, such as selling products, digital products. It could be rendering a service. It could be income from investing at the bank. You could earn commission income. So there are 4 ways to earn income. Sale of digital products, services rendered, interest on investments. Those are income accounts. Right, expenses. What is an expense? In order for the business to operate on a day-to-day basis, you need to spend certain amounts of money on certain items. For example, stationery, advertising, salaries, fuel, telephone, and wages. Those are examples of expenses. A vehicle. In order to run a vehicle, you need to maintain it and you need to buy fuel. So items that are used up in order to operate the business are expenses, costs incurred by the business in order to function. Oh, and that car's gone. Now, how do we calculate profit? Profit is simply you take your income less your expenses. And I'm going to say this right from the start. Assets, like cash in the bank, is not used to calculate profit. We take the value of our income less the value of the expenses, the income that was earned in the current year, and the expenses that were incurred during the current year. You find the difference between the two, and it will either be a profit or a loss. So from sales, we derive an income. If the income is greater than the expenses, that will be a profit. Income greater than expenses, it's a profit. So what is a loss? A loss is when the expenses exceed the income. So we got income. The income is less than the expenses. And what is that equal to? A loss. Just to recap, owner's equity is equal to the value of the assets minus liabilities. The owner is worth, or you are worth, in your individual capacity, the value of your assets less what you owe. Now we're going to get to the accounting equation, which is derived from owner's equity is equal to assets minus liabilities. The accounting equation is the fundamental rule of double entry accounting, stating that the value of a business's assets is equal to liability plus owner's equity. A is equal to O plus L. AOL. Now going back to the previous slide, what are you worth? The value of your assets less the value of your liabilities. Now if I take the liability to the left hand side, the sign will change to a positive. And what do we have there? If I write it out and I put assets on the left hand side, assets is equal to owner's equity plus liabilities. That is your accounting equation. Every single transaction will have an effect on the accounting equation. And in the next chapter, we're going to look at those effects on the accounting equation. The accounting equation, assets equals owner's equity plus liabilities. That is also the format of a balance sheet, which is now known as a statement of financial position. And just so you remembered, I put that on the aeroplane. Assets equals owner's equity plus liabilities. What are financial statements? I'm going to show you quickly before I finish up this video. Financial statements are formal reports that are user-friendly. They summarize a business's financial performance. Performance means profit or loss. And it also summarizes the position of the business at the end of the financial year, on the last day of the financial year. A statement of profit or loss and other comprehensive income is income, basically income minus expenses, written in a formal way. And an income statement or statement of profit and loss is the financial result of the business that is presented on a statement of profit or loss and other comprehensive income. It's called the income statement. Income less expenses. And there's the profit. And just before we move on to the next statement, that profit is added to capital, owner's equity. Right? Remember what affects owner's equity? DAS. But the profit for the year is added to the capital. And then it will go into the statement of financial position, because what is the statement of financial position? Assets equals, that's a equals, owner's equity plus liabilities. And the statement looks like that without the pictures. Assets, total assets, both current and non-current, is equal to equity and liabilities. So owner's equity plus liabilities. And look there, it balances because you applied all your rules. This shows the position of the business on the last day of the financial year. So these here are financial statements. And to end off this video, I will deliver the plane with the accounting equation, and I will even rub it out for you so you can see that and remember it forever. Green, red, blue. Not that the colors have anything to do with anything, but assets equals owner's equity plus liabilities. Right, we've been going for 32 minutes. You've watched lecture 1, and now you're coming to the end of lecture 2. You're reading your textbook. I've been focusing on chapter 2, so you need to go and have a look, watch the videos again, and don't forget to fill in the register once you've watched this video to show that you, in inverted commas, attended this lesson. It's important for our records, and management might want to see who has attended these lessons. So click on the link that was provided in the email or in the description of this video on my YouTube channel and complete the document saying that you've watched the video. I look forward to seeing you all when we meet face to face, but at the moment I am sure you are watching these videos over and over. Cheers, chat soon.